Welcome everyone to a mind-bending journey into the world of free money. Yes, you heard that right. Today we're diving headfirst into a topic that might just change the way you think about borrowing money, even if you're swimming in cash like Mark Zuckerberg or Elon Musk. Now, before you scratch your head and wonder why on earth a billionaire would ever take out a mortgage, let me hit you with a reality check. Sometimes borrowing is so smart, it's practically giving you money back. Imagine buying a multi-million-dollar home with a tiny interest rate that's lower than inflation. It sounds crazy, almost like magic, right? But this is no sleight of hand trick. It's a carefully orchestrated financial strategy that turns debt into a superpower. In this video, we're not here for boring numbers or endless charts. No, we're talking about the real-life financial wizardry that makes you go, wow, that's genius. From the curious case of Mark Zuckerberg buying his Palo Alto pad for $5.95 million on a 30-year mortgage, when he could have paid in cash, of course, to the brilliant moves by Elon Musk, Jay-Z, and Beyonce, we'll break it all down in a fun, digestible way. We'll explore how low mortgage rates can be your secret weapon, how leveraging other people's money might just be the trick to unlocking massive wealth, and why banks practically roll out the red carpet for the ultra-rich. Buckle up, because we're about to demystify the world of financial leverage with humor, relatable examples, and a dash of sass. Let's jump right in, because if you're ready to learn how to make money while sleeping, and maybe laugh along the way, you won't want to miss a single word of this. The allure of free money. Why borrowing makes sense for billionaires. Let's get straight to the point. Why would someone with billions in their bank account ever bother with a mortgage? Picture this. Mark Zuckerberg, the man behind Facebook, could have casually dropped cash on a swanky home near his headquarters. Instead, he opts for a 30-year mortgage on a $5.95 million home. Sounds bonkers, right? But here's the kicker. The interest rate on that mortgage is ridiculously low, just around 1.05%, which is even lower than the average inflation rate hovering between 2% to 3%. In other words, Zuckerberg is essentially borrowing money at a cost so low it's almost like free money. Think about it. When inflation outpaces the interest rate, the real value of the money you repay decreases over time. It's like buying a candy bar today and paying for it with coupons that are worth even less tomorrow. For billionaires, this means they can free up their liquid cash to invest in ventures that yield higher returns, turning what seems like a debt into a profitable tool. And let's be honest, who wouldn't want a little extra cash in their pocket? If you can invest the money you'd have used to pay in cash, and that investment returns, say, 8% or more over the long term, then you're not just saving money, you're making money work for you. That's the genius behind using a mortgage as a financial strategy. It's not about being strapped for cash. It's about making your cash work harder than you ever could on your own. The low-interest secret. Borrowing is your financial superpower. Imagine walking into a bank and being told, hey, we'll lend you $1 million at an interest rate that's lower than what you could earn by simply putting that money in a savings account. Sounds too good to be true? Well, for the rich and famous, it's just another day at the office. The idea here is simple yet revolutionary. When you borrow money at a rate that's lower than the inflation rate or the return you'd get from an investment, you're essentially pocketing the difference. Let's break it down with a simple example. Suppose you borrow $1 million at an interest rate of 1% per year. At the same time, imagine you have an investment opportunity, like an index fund, that has an average annual return of around 8%. In this scenario, while you're paying a meager 1% interest on your loan, your investment is growing at a rate far exceeding your borrowing cost. The result? You're effectively making a 7% profit on the money that isn't even yours. This might sound like the stuff of fairy tales, but it's a real-life financial strategy used by some of the world's wealthiest individuals. The secret lies in the delicate dance between borrowing costs and investment returns. When the cost of borrowing, the interest rate, is lower than the expected return on your investments, you're playing the perfect game of financial leapfrog. The bank is happy to lend you money because they know you're a low-risk, high-credit score customer, and you're busy making money grow by leveraging that cheap debt. This approach is not just for tech moguls. Even moderately wealthy individuals can use this strategy if they can secure a low interest rate. However, let's be honest, when you're dealing with millions, every fraction of a percentage counts. For billionaires, the stakes are astronomically high, and even a tiny edge in interest rates can translate to tens of thousands or even millions of dollars saved over time. It's like getting a magic discount on the cost of money itself. Leverage, the rocket fuel for your wealth-building journey. Now that we've uncovered the magic of low interest rates, let's talk about the powerhouse concept that makes it all worthwhile: leverage. In the simplest terms, leverage means using borrowed funds to amplify your financial gains. Think of it as a seesaw. By borrowing a small amount relative to your investment, you're able to lift a much larger weight than you could on your own. Let's put it this way. Imagine you want to buy a phone that costs $10,000, but you only have $10,000 in your pocket. You could go to the store and buy just that one phone, and maybe sell it for $11,000 to pocket a tidy profit. But what if instead, you borrowed an extra $990,000 from a bank, and with your own $10,000, you bought $1 million inventory of phones? Now when you sell all those phones for $1.1 million, you repay the bank and are left with a much larger profit margin. This is the power of leverage at work. This strategy, when executed correctly, can multiply your returns exponentially. However, it's not without its risks. Just as a rocket needs precise calculations to reach the stars, leveraging your finances requires careful planning and a solid understanding of the market. If the investment doesn't pan out, or if the interest rates suddenly spike, you could find yourself in a financial freefall. But for the savvy investor, especially those with a safety net of diversified assets and high creditworthiness, leverage is like rocket fuel. It propels your wealth to heights you never thought possible. It's all about balancing risk and reward. While a small miscalculation might lead to losses for the average person, the ultra-rich have the cushion and expertise to ride out the turbulence and come out on top. In the world of high finance, leveraging is not just a strategy. It's a way of life that separates the titans of industry from the mere mortals. Billionaire tactics. How the ultra-rich use debt to get richer. Let's now take a stroll through the glamorous financial playground of billionaires, where taking on debt is less about being in trouble and more about crafting a masterpiece of wealth. First up, we have Mark Zuckerberg. Yes, the Facebook founder famously chose to finance his Palo Alto mansion with a mortgage at an astonishingly low rate, even though he could have easily paid in cash. For him, it wasn't about the cost of the house. It was about keeping his capital free to invest in ventures that could potentially yield much higher returns. And then there's Elon Musk, the man who practically redefines the meaning of visionary. Instead of liquidating a chunk of his Tesla or SpaceX shares to buy a property, Musk opted to take out a $61 million mortgage to purchase 5 properties in California. With a manageable monthly payment that doesn't cramp his style, he keeps his cash reserves intact, ready to invest in the next groundbreaking innovation, or perhaps the next space shuttle. But wait, the plot thickens. The strategy isn't confined to tech geniuses alone. Even the music world's power couple, Jay-Z and Beyoncé, have jumped on the bandwagon. They bought a jaw-dropping $88 million mansion by putting down only 40% of the total cost, financing the remaining $52.8 million. It's like buying a luxury sports car with a small down payment and letting someone else foot the bill for the rest, while you enjoy the ride and watch your investments take off. What ties all these strategies together? It's the clever use of debt as a tool to maximize returns. By borrowing money at rates far lower than potential investment gains, these high flyers are not just saving money, they're making money. They're like financial acrobats, performing daring stunts that would leave most of us dizzy, yet somehow landing perfectly every time. And while the rest of us may tremble at the thought of debt, these billionaires treat it like a secret weapon in their arsenal, a tool that helps them multiply their wealth exponentially. Of course, this isn't a one-size-fits-all strategy. The rich have access to the best deals, the lowest interest rates, and a safety net that most of us can only dream about. But there's a lesson here. When you understand how to manage and leverage debt, You open up a world of opportunities to grow your wealth, even if you're not a billionaire yet. It's all about playing smart, taking calculated risks, and knowing when to let someone else's money work for you. Banking on trust. How strong relationships with banks make debt a breeze. Now let's shift gears and talk about the not-so-secret behind these brilliant borrowing strategies. Building an unbreakable bond with your bank. You might be thinking, how on earth do banks factor into this game? Well, here's the scoop. Banks love lending money to people who have a track record of paying their debts on time. For the ultra-wealthy, who have impressive credit scores and assets to back them up, banks are practically throwing loans at them like confetti at a New Year's Eve party. When you're a billionaire, banks don't just see you as another customer, they see you as a trusted partner. The logic is simple. If you have a history of managing your finances responsibly, the risk of default is minimal. That's why you often hear stories about celebrities or business tycoons securing loans at interest rates that would make even the most generous coupon collector blush. The banks know that if something goes wrong, these borrowers can simply sell a piece of their business or dip into their vast reserves to cover the payments. It's a win-win situation. The borrower gets access to cheap capital, and the bank secures a reliable client for life. But there's more to it than just a good credit score. It's also about the relationships and trust built over time. Think of it like this. If you're the type of person who always pays back your friends when you borrow money, your pals will trust you with their cash in the future. On a grander scale, when you consistently honor your mortgage payments, you build a rock-solid financial reputation that opens doors to even better deals down the line. In the high-stakes world of finance, this kind of trust can be worth millions. For the everyday investor, establishing a strong relationship with your bank might seem like a tedious chore. But for those looking to dive into the realm of low-interest debt and leverage, it's an essential step. It's about proving you're a responsible borrower, someone who knows how to juggle finances without dropping the ball. And when the bank sees that you're not just some amateur, but a savvy financial operator, they're more than happy to extend you the kind of low-cost loans that can transform your investment strategy into a goldmine. The dark side of debt, risks, pitfalls, and financial freefalls. Now, before you get too carried away dreaming of free money and sky-high profits, let's have a quick reality check. While borrowing money at low interest rates might seem like the ultimate financial hack, it's not all rainbows and unicorns. There's a darker, riskier side to the story that even the richest among us must navigate carefully. For starters, most of these ultra-low rates are adjustable, which means they can change over time. Imagine you're happily cruising along on a road with a steady speed limit of 1%, only to hit a patch where the rate suddenly jumps up. Kind of like unexpectedly running into a traffic jam on your way to a holiday party. That slight increase might seem insignificant at first, but when you're dealing with millions of dollars, even a 0.5% rise can translate to tens of thousands of extra dollars in interest. Suddenly, what was once free money starts to feel like a leaky faucet draining your bank account. Then there's the personal risk factor. The rich have safety nets in the form of diversified assets and high credit scores. For the average person, however, taking on such debt can be a dangerous game. Life is full of surprises. Job loss, unexpected medical bills, or even a global pandemic can upend your financial plans in an instant. Without a robust backup plan, a sudden increase in interest rates, or a dip in your investment returns, could lead to a financial freefall that you simply can't afford to recover from. We've all heard the cautionary tales of financial crises, and none are more infamous than the 2008 housing crash. Back then, banks were giving out mortgages like candy, even to those who couldn't really afford them. When the bubble burst, it was like watching a row of dominoes collapse. Suddenly, millions of people found themselves underwater, and the entire economy took a nosedive. While the strategies employed by billionaires are far more calculated, the inherent risk in leveraging debt remains. Even the smartest investors must tread carefully, ensuring that their potential rewards always outweigh the risks. It's important to remember that debt, when mismanaged, can quickly spiral out of control. The key is knowing your limits and having a solid plan in place. For every Mark Zuckerberg or Elon Musk, There are countless cautionary tales of individuals who took on too much debt and paid a steep price. So while the idea of using debt as a tool to build wealth is undeniably enticing, it's not a magic formula that guarantees success. It requires constant vigilance, a keen eye on market trends, and a willingness to adjust your strategy as conditions change. Leverage in action, real-life examples and calculations. Let's break down some numbers and scenarios to illustrate just how powerful and potentially perilous financial leverage can be. Picture this. You have an opportunity to invest in an index fund that, on average, delivers an 8% annual return. Meanwhile, you secure a mortgage at a mere 1% interest rate. On paper, this seems like a no-brainer, a 7% spread that goes directly into your profit margin. Now imagine scaling this up to millions of dollars. For example, if you borrow $10 million at 1% interest and invest it in an asset that returns 8% per year, your gross profit before any additional costs would be around $700,000 annually. Multiply that by 30 years, and you're looking at a substantial sum, if everything goes according to plan. However, let's not ignore the fine print. The interest rate on most of these deals is adjustable. That means, in the future, your rate might creep up, and your calculations could change. The bottom line is that while the math may look dazzling on paper, it's a delicate balancing act that requires constant monitoring and a knack for predicting market trends. Another way to think about it is to imagine you're playing a game where you bet a small amount of money to win a much larger pot. The richer you get, the higher the stakes, and the greater the potential payoff. But if the game turns against you, you might find yourself in trouble faster than you can say mortgage crisis. The key to success with leverage is to remain agile and always have a plan B, C, and even D, just in case the numbers start to look less favorable. The psychology of debt. Why owing money isn't always a bad thing. Let's switch gears for a moment and talk about the mindset behind borrowing money. For many people, the very idea of taking on debt conjures up images of stress, sleepless nights, and endless worry. We're taught from an early age that debt is bad, and that paying in cash is the only responsible way to handle finances. But as we've seen, in the world of high finance, this isn't necessarily true. For billionaires and savvy investors, debt is viewed not as a burden, but as a tool, a resource that can be leveraged to amplify returns. It's like using a credit card wisely. When done right, it can boost your purchasing power and help you access opportunities that would otherwise be out of reach. The trick is to shift your mindset from "I owe money" to "I'm using money as a tool to make more money." This mental leap isn't easy, especially when most of us have been conditioned to fear debt. But consider this. If you can borrow money at a low rate and invest it in something that grows significantly over time, aren't you essentially turning the tables on the very idea of debt? Instead of being weighed down by interest payments, you're harnessing that very interest rate to create a profitable cycle. It's a paradigm shift that might seem counterintuitive at first, but for those who master it, the rewards can be enormous. How to get started, even if you're not a billionaire yet. Now you might be thinking, this all sounds amazing, but I'm not exactly rolling in billions like Zuckerberg or Musk. Don't worry, we're not here to leave you in the dust. While the ultra-rich have access to the very best deals and the lowest interest rates, there are still lessons that everyday investors can learn from their playbook. First and foremost, educate yourself. Understanding the basics of interest rates, inflation, and investment returns is the foundation of any smart financial strategy. Look at the numbers, run the calculations, and see for yourself how even a small difference in interest rates can lead to significant gains over time. Next, build a solid credit history. Banks reward those who consistently pay their bills on time with lower interest rates and more favorable loan terms. It might seem like a no-brainer, but having a strong credit score is your ticket to accessing the best borrowing deals available. Finally, be strategic about your investments. Don't just take on debt for the sake of it. Ensure that you have a well-thought-out plan for how you're going to invest the borrowed funds. Whether it's in an index fund, real estate, or even your own business venture, the goal is to earn returns that comfortably exceed your borrowing costs. And remember, Even if you're starting small, every step you take towards leveraging your resources wisely is a step in the right direction. Debunking the myths, common misconceptions about debt. There's no shortage of myths and misconceptions when it comes to debt and borrowing. Many people equate debt with financial weakness or irresponsibility. But as we've explored, when used correctly, debt is a powerful tool that can unlock opportunities and drive wealth creation. Let's debunk a few of these common myths. Myth number 1. Debt is always bad. Not so fast. For those who understand how to manage it, debt can be a strategic asset. When the interest rate on your debt is lower than the return on your investments, you're essentially earning a profit on money that isn't even yours. It's like having your cake and eating it too. If you can borrow at 1% and invest at 8%, you're clearly in a win-win situation. Myth number 2. You should always pay in cash. While paying in cash might give you a sense of security, it's not always the smartest financial move. For high net worth individuals, tying up all your liquid assets in a single purchase can mean missing out on other lucrative investment opportunities. In the world of big money, it's all about keeping your options open and making sure every dollar is working as hard as you are. Myth number 3. Borrowing means you're in financial trouble. This one is a biggie. Many people associate borrowing with financial distress. In reality, strategic borrowing is a hallmark of savvy financial management. When done correctly, it's not a sign of weakness. It's a calculated move to optimize your wealth. The key is to borrow wisely, invest intelligently, and always keep an eye on the balance between risk and reward. The future of borrowing, trends and predictions. As we look ahead, the world of borrowing and leverage is evolving at a rapid pace. With technology driving innovation in the financial sector, we're likely to see even more sophisticated tools and strategies emerging for both the ultra-rich and everyday investors. Digital lending platforms, automated investment services, and data-driven financial advice are making it easier than ever to navigate the complex world of debt. For instance, imagine a future where artificial intelligence analyzes market trends in real time, automatically adjusting your loan terms or investment portfolio to maximize returns. Sounds like something out of a sci-fi movie, right? But in many ways, that future is closer than you might think. The principles remain the same. Leverage, low interest rates, and smart investments are the keys to financial success. However, as with any rapidly evolving field, there are also challenges. Regulatory changes, economic shifts, and unforeseen global events can all impact borrowing costs and investment returns. The 2008 financial crisis serves as a stark reminder that even the best-laid financial plans can go awry if the risks aren't carefully managed. As the financial landscape continues to change, staying informed and adaptable will be more important than ever. Balancing ambition and caution in your financial journey. If there's one takeaway from our deep dive into the world of low-cost debt and leverage, it's this. While the promise of free money is incredibly alluring, it must be balanced with a healthy dose of caution. The strategies employed by billionaires are not for the faint of heart. They require meticulous planning, a robust risk management strategy, and the ability to pivot when market conditions change. For everyday investors, the idea of borrowing to invest might seem like walking a financial tightrope. But remember, every great financial achievement starts with a willingness to take calculated risks. It's about being smart with your money, learning from the successes and failures of those who came before you, and continuously educating yourself about the ever-changing financial landscape. The art of leveraging debt is like riding a roller coaster. Thrilling, sometimes a bit scary, but incredibly rewarding if you know when to hold on tight and when to let go. It's not a strategy to be adopted blindly. It requires knowledge, discipline, and a clear understanding of your financial goals. Whether you're aiming to scale up your investments gradually or dreaming of one day joining the ranks of the ultra-wealthy, the principles remain the same. Make every dollar count, invest wisely, and never underestimate the power of a well-structured debt strategy. So what have we learned today? In the grand theater of finance, borrowing money isn't a sign of weakness. It's a strategic tool that, when used wisely, can catapult your wealth to new heights. Whether it's Zuckerberg's cheeky mortgage move, Musk's multi-property wizardry, or even Jay-Z and Beyoncé's savvy real estate plays. The ultra-rich have long understood the secret. Sometimes, debt is the best friend you never knew you needed. Remember, the key to success lies in balance. Embrace the humor in the seemingly paradoxical nature of borrowing money when you have billions, but also approach it with the seriousness it deserves. Every financial decision should be weighed carefully, every risk calculated with precision, and every opportunity seized with both hands. The world of low-cost debt and leverage is a roller coaster ride, thrilling, unpredictable, and potentially life-changing. And while it might seem like a game reserved only for the elite, the underlying principles can be applied by anyone with the courage to learn and the willingness to take a few risks. So, as you leave here today, think of your money as a resource that, if managed smartly, can work for you in ways you never imagined. Whether you're a seasoned investor or just starting to dip your toes into the financial waters, remember this: sometimes, borrowing isn't about being in debt. It's about borrowing smartly to build a future where your money is doing all the heavy lifting. And if a billionaire like Zuckerberg can get away with it, why can't you? Thank you for joining me on this deep dive into the hilarious yet fascinating world of low-cost debt and leverage. I hope you now see that borrowing money, when done correctly, isn't a sign of weakness, but a clever strategy that the ultra-rich have been using to build empires. Whether it's securing a low-interest mortgage like Zuckerberg, leveraging debt to multiply returns like Musk, or simply understanding that sometimes a little debt can be the best financial move, the lessons here are invaluable. Remember, every financial decision is a step on your journey to a brighter, wealthier future. And if you can laugh along the way, you're not just surviving the ups and downs of the market, you're thriving in them. Here's to borrowing smartly, investing wisely, and always keeping your sense of humor intact. After all, in the grand game of wealth, a little laughter might just be the secret ingredient that makes all the difference.